Thanks, Christian. And since it's the last session, I do want to use the opportunity to thank the organizers of all of this, to make this possible. We all know, at least all of us do something in terms of organizing, how much work it always tends to be, more than one expected. I happily serve on the program committee, and the papers get better and better every year. And sometimes I say that just to be polite, but for this one, it's really true. It's amazing, the quality of papers that I see. So I consider myself lucky that I'm part of it. Obviously, I haven't seen my own paper in the stack of papers. With me is Boyan Jovanovic. He's gonna help me out, hopefully, when I get stuck in my reasoning. We have been working on this paper for more than a decade now. So repeating the material over the years is a way to get to not lose track of what's going on. This is a paper about bidding, and it's not a microstructure paper in a very narrow sense of describing accurately what's happening, going from tick to tick in microsecond markets. It's more zooming out and thinking about deep pocket participants in the market who might be supplying or not supplying liquidity and put in a bid, but then not a bid for a couple of thousand shares, but for sizable amounts. And that's what you have to bear in mind when I talk you through results that we have for this paper. Let me just simply walk you through it. There's a couple of interesting numbers coming up. Even if you don't believe our interpretation of it, I think the numbers will interest you, because we've done quite a bit of data analysis. The motivation, I'll be quick. There's concern about market liquidity ever since the financial crisis, well, the previous one, right? We have BIS 3, Dodd-Frank, Volcker rule, and somehow we're constraining participation of intermediaries in the financial marketplace. And there's a lot of people arguing that in general liquidity has gotten worse. There's less dealer risk-taking, is what the BIS reported in 2014. So what's the evidence? Well, the bid-ask spreads are sort of flat. I mean, there's no obvious evidence there that the liquidity supply somehow is less. But again, this is not a paper about bids for 100 shares. This is a paper about real money put on the line in terms of bids for larger orders, and that's where the evidence starts to come in. That large orders seem to be more costly to execute these days. And there's a bunch of references here, but not only that, we also see that markets seem to be more prone to crashes. So not only equity markets, but also currency markets, we've seen evidence. And every time I visit a regulator, this is on top of their agenda, the crashes. I mean, the average liquidity, I mean, they should care about it. They care about it not so much, in my view, but they care a lot about crashes. And obviously, when a crash happens, that's where the regulator is on TV, on the media, and has to explain things. So I'm sort of understanding their focus on crashes that way. And there's some evidence there. Now, what's the model? We have bidding for a common value, and it's a first price auction. So in that sense, it is like a limit order book that we all microstructure people understand. But this is the crux. Participating is costly. We don't put down our hats on where this costs from, but there is a sense in which, if you want to put a bid together, you have to spend some effort. For one, you need to figure out what the latest value is of what you're bidding for. You need to see who else is in the market, potentially, et cetera, so how large the market is. So there is some cost to putting in a bid. And you don't have, at the time that you put the bid in, you don't have information on how many others are actually bidding. So this is the notion that that maybe, even in limit order markets, you typically don't see all the way through the books beyond the best quote. What's the equilibrium? Well, we'll show that, and this is a summary of the paper. Huh? So bidding is not in pure strategies. There's actually no equilibrium in pure strategies in this case. And the key is costly bidding here. That immediately kills pure strategies. So one has to revert back to mixed strategies, equilibrium, and then also we have, and it's already in that mixed strategies, right? So mixed strategies are related to randomness. And you see where this is going. If we see crashes in markets, then maybe there's some randomness to it. So we're bidding in mixed strategies, and then the bid price supply therefore, so the mixed strategy essentially, you toss the biased coin on whether you're going to participate or not in the game. And if you participate, if the coin turns on the side that you decide to participate, then the bid you're going to put in is again not a pure strategy bid. It's going to be a distribution. It's drawn from a continuous distribution. And we're after identifying those first in the model and then trying to estimate them with data. We find that the bid price distribution is negatively skewed. Literature review real quick, but it's important. It's always important to project on literature to see what's new here. There's a big literature on market liquidity. That's where this paper is in, but it's slightly different from other papers. But the literature has already pointed out that for liquidity supply, it's not just the mean that matters. It's also the randomness of liquidity supply, which is of course, and you see again, this is nicely talks to the mixed strategies. That's where we're trying to get some structure using the model. There's almost no theory for where this liquidity risk comes from. There's a nice paper by Baruch and Glosson on fleeting orders, but that's it. Plenty of evidence of left skew in bids. So if we look at bids, of course we have asks and bids in Microstructure, but we're focused on bid side here. Typically you have a lot of bids that have prices that are close together and relatively high compared to the rest, but there's always a few bids far away from the best bid, and they tend to be sparser, and that's distribution-wise the language for that. There's a left skew in bids. And there's no theory to the best of our knowledge on that, on why this skew is. And we have some work on strategic bidding and ECB auctions, bidding literature. This is more IO, less finance. Levin and Smith, price dispersion, markets for marginless goods. This paper is there. There's the Prescott paper on bidding or putting prices out when there's uncertainty for firms and their customers, or there's captive customers that firms have. And there's some literature here that has that randomness more in economics than in finance, that has randomness in prices as an outcome of a model. All right, so what is the model now on Amsterdam? Let me take a quick look at the clock. So we're 10 minutes in, so I have another 15 minutes left. Here's the gist of the model. I already said that there's a common value, sealed bid, first price auction. The number of players are larger or equal to 2. There's a single object here that people bid for. That's one good thing. The next large market order coming in, if you will. It's valued at V, so there's a common value V. Those who consider putting in a bid, they pay a cost C to do so. And the seller reservation price is U. So if you put a bid below U, I mean, you might as well not bid because the seller's not going to accept it. Player has two actions, and I already said that: either participate in the bidding or no. If you don't participate, you save the cost C, right? You might as well put your attention elsewhere and forget about bidding in this round for this particular security. And if you enter, you decide the bid price B. And we study equilibria because it's got nice expressions for n tending to infinity. But we even, over the years, we even considered the finite n case, and it's very similar in many ways. So here's the central proposition of the paper. The symmetric equilibrium is unique and is in mixed strategies only. Number of bidders who decide to bid is Poisson. So there you have the first randomness, right? So the number of people participating in a round is Poisson, with mean, that's easy to compute. And a nice expression, it's the natural logarithm of V minus U. So V was the common value for the bidders, U was the reservation price of the seller. So that distance is important for where the number of people bidding, divided over the cost of bidding C. And this sort of makes economic sense, because if you raise the cost for putting in a bid, on average, less people participate in the game. But again, I want to emphasize the participation is random, it's Poisson. Those who then toss the coin and decide to bid, they're going to put in a bid with CDF that's here. And I'd like to focus on the corresponding PDF, the probability density function. That's here. It's 1 over m times 1 over v minus p. So m is again the average number of middlemen in the game, and that is this function here on the second bullet point. And one is, and the second one is where is the price that you're evaluating relative to your value or everybody's value of the security, and everybody in the bidding calculation. So it's very clean, very easy, and that's, of course, that's partially a result of letting n to tend to infinity. The first corollary is the density of the bids. If you stare at that expression long enough, you'll find that it actually is strictly increases in P and is convex. So if the density increases for the prices that you consider bidding for, there you have the left schooners, immediately. So that's a correlate. So that sort of can explain the evidence that's already out there, that deeper into the book, there's fewer quotes. The best bid distribution, so in some senses, particularly for the seller, it's interesting not to know about number of people participating or what the distribution they use to bid, but it's more interesting to consider what the distribution of the best bid is, because that's ultimately what they get. Remember, there's a single unit that's being auctioned off here. And there we also have schooners. So here is basically, well, let me skip this one in the interest of time. What is interesting is if you compute that model implied distribution of the best bid, you get something that looks like this. If you increase the cost of bidding, you get, and these are typical box plots where the box indicates the interquartile range, and the whiskers indicate the 1 in 99th percentile. Notice that, and this is bids. Notice that the schooners is there because the bottom whisker is much larger than the top whisker. That's basically the result of schooners. But what I want to emphasize in this picture is that it's huge, right? It's huge. So this, and of course, this has connotations with, there might be a situation where the best bid is very, very low probability, but the best bid is really low. That's the case where probably very few people happened to participate, and they drew a bid that was relatively low. So the point is, it can happen. All right, data. The data that we have here is, I'd like to advertise this database that Nicholas Hutch put together along with others. It's essentially in the NASDAQ order book, the NASDAQ in the US. You've got snapshots for any security that trades on NASDAQ ever since 2007. And, you know, some of you, probably the majority, have worked with this type of data. It takes a lot of cleaning and understanding, but this has been done for you in this data set. So you really get, at every instant of time, you get the order book, and we took it for SPY, which is one of the most actively traded ETF. And this is for a long time range. And since it's so actively traded, there's so many quotes, in fact, that we had to make a choice. So we took the, for the first full week of every quarter, we took the Wednesday. Downloading a single day takes a day. So it was a long time to put this data set together. But then you have the distribution of bits in snapshots throughout the day. And then we looked at depth up to 50 basis points below the best bid. So what are the summary statistics on that data? So here is the, and that's sort of, you see the crash here, and the prices coming up all the way to 2018. The COVID, of course, it hadn't happened yet. And then you have bid-ask spreads. They've come down in this period. And again, this is 2007 all the way to 2018. Depth, and this is amazing. This is a simple count on how many shares are there between the best bid and 50 basis points below the best bid. If you do a count, that was thousands of shares at the start of the sample, and it was really almost nothing towards the end of it. So there is a lot of depth missing, if you will. Even at the best bid, the depth declined a lot over those years, and there's also less volume. Okay, and these are just summary statistics. But interestingly, the best bid, the bid price distribution that we had generated endogenously looks very much like the corollary one, right? So that you have a increasing PDF here. Of course, the equivalent in the data is frequency plots. There you have them for the entire sample. It's all in the paper. But now I want to use my last few minutes to show how we estimated the model. We used GMM, and we thought hard about what are three characterizing moments to get out to the three parameters in our model, which are V, U, and C. Those are the parameters that we want. So we need at least 3 moments. And then you have to think about what moments should identify those. What are reasonable moments to take? Well, here is what we decided to take. One is bid aggressiveness. So what is the frequency at the higher end of the bid of the range relative to the lower end of the range? So in other words, how strongly are bids clustered close to the top? That's going to be defined M1. Mean number of bids, because we can do simple counts on the number of shares in the top 50 range. And then we have both variation and mean of the number of shares from best bid to 50 basis points below the best bid. And the variability therein, it's sort of natural to take that as a moment, because what we have, what's crying out from the model is the randomness in the whole thing. And so this captures that randomness, the variability in the number of shares in the top 50 basis points. You tend to think that, at least I thought going into this project, that it's kind of very stable and negligible. Well, it's not. There's a lot of randomness here within a day, because every day for us is a single data set, a single sample. Okay, we'll estimate the parameters per day. And then we have the bid-ask spread, good old bid-ask spread, which makes sense to have. Empirical moments are here in the ones I just described. The slope of the bidding density. I'll run them by you quickly. So there's very much clustering at the top in the middle of the sample, 2014 that is. So very aggressive bidding there. I don't have time for it, but that means that if you look at the expressions for the model again, that the common value of getting the asset was actually very low for whoever bid there. And this was the time when the Volcker rules were staged in. Coefficient of variation, so the randomness of the number of shares in the top 50, so from top bid to 50 basis points below top bid, it hovers between 20% and 30%. So again, it's coefficient of variation is a standard term in statistics. It's sigma over mu. Bid-ask spread slightly going down. So what are the barometer estimates? The value to the middleman of winning the contest minus the mid-quote. So this is essentially the value to minimum has gone down over time, is what the model suggests, as a first pass on the data. The mean number, and this is kind of an economic interesting thing that comes out of the model. The mean, so the number of deep-pocketed investors that participate in putting significant supply in for the SPY has gone down from about 50 at the start of the sample towards less than maybe a dozen at the end of the sample. And interestingly, I marked out this area where we're implementing the fallout from in terms of regulation from the crisis all the way from 2010 to 2014, and this is where the Volcker rule became active. That's sort of corresponding to a strong drop in the mean of liquidity suppliers. Cost of bidding is relatively constant, and in the sample, what's really gone down is the reservation value for what's really gone up, because this is 1 minus the reservation value. So the reservation value for the seller has really gone up. Okay, meaning if he comes to the market still a big position, he doesn't. He's a bit pickier. He can be a bit pickier about whether or not to sell, because holding it himself is worth more. And that might have something to do with agency algorithms are becoming more I'm sorry, my computer says I have to take a 5-minute break now. So I hope I can turn it off. But this is with this timeout software, it forces you to take breaks. Anyway, I'll just continue talking, and I'm working on the assumption that you still hear me and see the slides. And this is the final thing. When everything's said and done, and one of our referees said that this should be maybe even part of the abstract. He liked it, or he or she liked it so much. Is when you sit down and you let everything sink in. And hopefully you get a little bit of intuition for where this is coming from based on everything I said. If there is randomness in participating and randomness in drawing the price when participating, then you can do a quick back of the envelope exercise and compute for our sample, 2007, 2018, 1.5-year sample. Suppose every day we're an independent draw, and let's take for a moment, let's take the parameters seriously. Well, if everything's an independent draw and there is some probability of an empty book, which the book is empty when, for that probability, the book is empty when the outcome of the Poisson, the number of people participating of the Poisson distribution is 0. And that's a positive probability that it's 0. You have an empty book. Well, we never really have empty books in microstructure, but at least there is the deep pocket people did not participate. So that whatever is there is very, very thin. So it's binomial. And of course, the probability of that happening is what our model implies. It's very, very small. Its probability of it happening in the model is 0.00018. But that's for a single day, an empty book. But remember, for this sample, we have 11.5 times 250 days, which is somewhere between 2,500 and 3,000 days. Then you can do the numbers using the binomial distribution. You can compute what the probability is of that there is one day in that sample that the book is empty, that it has so happened to be that nobody participated. So that's probability you can compute based on these numbers. I invite you to do it. It's 31%. So the probability of finding a single day in that entire sample of a fickle market, like a crash, is 31%. Of course, 60% is the probability that there's somebody participating. But this is a serious probability. And then, of course, the question is, was that perhaps the day where the modern era crash in equities happened? And SPY, of course, was part of that. Okay, let me conclude. Lots of information, very dense presentation. I understand. We worked on this 10 years, and every time I have to get the pieces together. But what is ultimately here is if bidding is pay to play in a way, right? So if you want to participate in a round, you have to pay a cost. It might be a very, very, very small cost, but there is a cost. Then homogeneous bidders bid not in pure strategies because there's no equilibrium. It has to be mixed strategies. They first decide whether to participate or not, and if you look at it from the outside, there's randomness in the number of people participating. We show that it's a Poisson distribution, and for each and every one of them, the participants, they draw from a non-degenerate distribution. Bear in mind, nobody can condition what the others are doing because it's a simultaneous move game, right? So you can't see what the others are doing. You have to put in your bid now. We applied it to bidding in financial markets, and there's a remarkable fit for a model that has only 3 parameters. Let me stop here and turn it around to the discussant, but also I want to hear your views, thoughts, and maybe opportunities for follow-up work for the entire audience. Thanks a lot.
Yeah, thanks a lot, Christian. So when I was asked to discuss this paper, I was told that this will be already forthcoming. And so my mission, besides I have seen this paper for quite a while now, and I think it's a great paper, and I encourage you to read it because I will not be able to do justice to it, especially not to the empirical part. So mostly I will talk about theory. And since this is forthcoming, I was suggested by Albert that I could kind of see whether this kind of paper can be regarded as a more mainstream, or how exactly can be interpreted from a more microstructure perspective, kind of going down to the details, the nitty-gritty of the limit order book, let's say. So I'm gonna refer to that a little bit. But first, I will explain why I think the paper is great and what impressed me the most with it. Let me just. You've seen already Albert did a great job in presenting the paper, so I don't have to say much about it. The interesting thing is that the stylized facts that justify this model are that the beta spread has remained relatively flat, but somehow it seems that large orders, so besides the best bid and ask, there seems to be less liquidity, and as a result, markets are more prone to flash crashes. So it would be nice to have a model that explains that. And the model has costly bidding. I'll explain why that's important, and endogenous bidder participation. And so I think it's quite a clever model, and I'll show. In fact, I have discussed the Baruch and Gloston paper, which is the closest perhaps to this paper. I have discussed it twice. First, it was before Larry Glosson took over. So it was like 2008. It was an NBR microstructure conference. And then in 2013, I discussed the Baruch and Gloston paper. So I've seen what they were trying to do. And I think they were trying to do a paper like yours, but they were stumbling upon some. I will explain where I think they stumbled. So it's interesting to see this paper that solves their problem to some degree. All right, so the model is simple, relatively simple. It's a first price common value auction. So the seller has the object, has a low reservation price called U, and the bidders have a higher value, V is the same, and there's a small cost. Think of, you can think of V equals 1, U equals 0, and the cost very tiny, 10 to the minus 4, 5, something like that. I think they take it in their calibration. And or at least in figure 2, and there's not much discussion about what this C represents, so it will be interesting to be more specific later on, but I will come back to it later. So there are n bidders, and the paper studies the equilibrium as n goes to infinity because they are simpler formulas. And bidders do not, they submit their bids simultaneously. They don't observe how many others are bidding or things like that. Okay, it's an endogenous entry as well. All right, so, and the interesting thing is that there's no equilibrium pure strategy, something that the Baruch and Gloston struggled a lot with. In fact, they had a proposition which was not even sure, it was very hard to prove, to show that there's no equilibrium in pure strategies. In the end, their paper took the direction that there is an equilibrium in mixed strategies. So, of course, their paper is about sort of the nitty-gritty of the limit order books, and it's more complicated. But they tried to get to this result, and they couldn't do it. And it took me a while to figure out what exactly made this paper get such a simple result. And it turns out that is this sunk cost that the bidders already pay. If the top bidder chooses some price, then it's optimal for the other bidder would want to deviate to P plus epsilon, something less than V. Okay, and since the cost, however, is already sunk, it was already paid, then this is kind of a Bertrand competition. The top bidder's payoff becomes less than 0, and ex ante, the bidder would not want to enter this game. So that's why there's no equilibrium pure strategies. The fact that the costs are sunk in this model. I will give in the next slide another example which will show something hopefully interesting that resembles this. It clarifies a little bit. And so there's a unique equilibrium in mixed strategies. The number of bidders who decides to enter is Poisson, has a nice mean. This mean is increasing in, if the bidders believe the valuation is higher, there's more of them. If the seller is more desperate, there's more of them. And if the cost of participating is smaller, there's also more of them. Lots of these results are intuitive and simple, which is very nice. The entrant bidders, though, so this is a mixed strategy, which means that you have a range, which here is between the seller's reservation price and V minus C. You don't want to lose C. So you choose a price at random with density given by this function, which is increasing in P, and it's convex, as Albert said. Okay, and the intuition in general, while you have mixed strategies, you are indifferent between all these different prices. So a higher bid price means, well, I get a higher probability of winning because I bid higher, but also I get a smaller payoff. So because the overall payoff is the probability of winning times the payoff, then I'm indifferent between all these different prices, and therefore I can choose at random between them. If you remember, in order to have an equilibrium mixed strategies, you need to be indifferent between all the prices. So I don't know if you ever saw the Bertrand competition. I thought it would be fun to come back to look at it. This is something that not many people know. Maybe Boyan has seen it because he's sort of has a stronger, perhaps, economics background than most of us. But the Bertrand competition, actually, if the buyer has an infinite valuation, he's like infinitely desperate to, then there's also another equilibrium besides the pure strategy equilibrium. Okay, so the pure strategy that you pay the marginal cost, this is a Bertrand, but there's also a mixed strategy. So for each price above the marginal cost, you get a strategy that gives you a positive payoff. Okay, so over P0 infinity, you have some kind of, this is the cumulative density function. And, the same intuition goes that a higher price means I can raise my price very high and I have a higher payoff. but I also have a lower probability of winning, yeah, because the other one also chooses randomly. So if I choose a very high price, the other seller may is very unlikely that will get a price above me. Okay? It's a very small probability. So I execute rarely, but when I do, I get a very high price. So then the payoff is the same for all prices, the expected payoff, and then it's a mixed strategy equilibrium. That depends on the fact that any price you have, there's a small probability that you win, that the other seller will bid a little bit higher. I don't know if you were aware of this mixed strategy equilibrium in the Bertrand, and so, but yeah, so, and the positive, this is a positive profit. But then if you have an entry cost, then the pure strategy equilibrium disappears, and the two sellers could fend off entry by choosing the mixed strategy equilibrium. So it's kind of similar to I kind of realized that it's similar to their paper, that even in Bertrand, if you have entry, you would get this mixed strategy equilibrium. I don't know, just a fun fact for those who like IO stuff. All right, so just comments, there's some very nice features of the equilibrium. So the assumptions are reasonable. And so here, you know, the CDF, the density is over an infinite interval. You assume that the buyer has an infinite top valuation. That's not the case here. The buyer's density has finite support. You may not appreciate that, but believe me, it's hard to get. So it's actually nice that you get, you know, reasonable assumptions and finite support densities. The bidders have the common valuation is finite, and you get nice closed form solution and no pure strategy equilibrium. And others have tried, you know, and Baruch and Gloston have this. I don't know. I only saw the 2013 version. Albert has a 2019 version. I don't know. I wish I could. So the paper was either fleeting orders or flickering quotes. It's very interesting stuff. But they, you know, it's difficult to get this no pure strategy equilibrium. They only looked at the mixed strategy. They have a dynamic model where they keep changing the quotes all the time. Yeah, because you get a draw from the density, which is the same, but you get a draw each time. So your quotes go all over the place. The model in this paper, in Albert and Boyan's paper, is not, it's a one shot. So it doesn't have all these dynamics, but it will be interesting to have it. So it is intuitive, but it has some surprising results. Let me say some key results. Albert already mentioned them, but so the nice thing is that the best bid depends less on C. Okay, there's a lot of bids at C, close to C, and then the rest of the density is then the rest of the density. So there's a hidden fragility there. You see the bid-ask spread being the same, but the bids below are not the same depending on the assumption, on the parameters. The probability that no bidders show up is actually bigger than zero. This is something which I find surprising. One may think that should not happen in the limit where n goes to infinity. And I started thinking a while. I didn't wrap my head against around this statement. So I find that surprising. So it's nice to. I wish I could have a better intuition, but I don't. But it's a nice result of the probability that there's no the order book is empty. The density of bids is convex and increasing in P because most of them get closer to C and prices are less skewed. The intuition is that low bids are unlikely to win and they provide a large payoff. So there's a little mass at the low bids. So there's a lot of mass at high bids. I mean, V minus. So the empirical result also that I found very interesting is that the 7.8% annual decline in bidder participation from about 40 at the beginning of the sample, 2007 to 20 at the end in 2018. So that's an interesting fact that they get out of the model. It's interesting to explain where this comes from. All right, so the fragility, I think Albert explained very well this figure 2 in the paper, that as you increase the cost of participation, then you get much more fragility, that the prices are much more left skewed. All right, and you know, if I was the discussant of a non-forthcoming paper, I would present this as sort of limitations, but as it stands, I think it points to, the model is very simple, so I don't think it should be complicated. I'm happy that the paper is as it is, but some small limitations of the paper point towards future research. So, you know, this is a one-sided model. It'll be nice to have a two-sided model, obviously, with where both sellers and buyers interact. There's a one-period model, while liquidity is inherently dynamic. So in practice, bidders, after a while, they observe if no one is trading, So, that would be interesting to have a multi-period model. So there's no limit order book. Traders can usually choose between waiting with the limit order and executing immediately with a market order. So that would go with having a multi-period model. That will make the model a bit more realistic, perhaps. This is what would become more microstructure. Given their assumption of ex-ante cost, I think the intuition will still go through. So that would be a nice kind of mainstream microstructure paper that would give some foundations for this paper. Once you get mixed strategy, you go back to Baruch and Gloston, who are quite excited about these flickering quotes. In reality, do bidders change their bids all the time? It's not very likely. Maybe there's a fourth parameter in a dynamic model, probability of changing the bid. Maybe it's okay to not change the bid for a while, but then others change. So then I'm not quite sure, but I think this is where a multi-period model would go. So the bidding cost also the paper doesn't take a stand on what it is, but this is very related to the bid-ask spread. So if you're more explicit of where C comes from, order processing cost, attention, that would become a new component in some sense of a bid-ask spread, and I think it's interesting. All right, so there are other models of the limit order book, in particular my own, which is all based on impatience and dynamic. People stay on different levels because if I stay on a higher level, I get a higher price, but I also wait longer. And so, it'll be interesting to compare this type of order books based on impatience with their model, which is based on something else. On their intuition. So as a summary, I believe that's a great paper, likely to be very influential. So, it's like a workhorse model that can be extended in different directions, hopefully. And it has reasonable assumptions, closed form solutions, everything you would want to get. And that's nice that they get no pure strategy equilibrium. That's to be compared with Baruch and Glosner, who kind of struggled to get that result. And it's nice that they get it. I think it's because of this ex-ante cost, which is a clever solution and intuitive as well. And they get nice and very interesting results, especially about fragility, which I think it's the main contribution of this paper to help us understand. So future research, two-sided model, multi-period model with limit and market orders, explicit interaction of interpretation of mixed strategies. What is the connection with flipping orders, flickering quotes, and and how is that related to fragility in particular? If people go over time and they change their quotes, how does that work in a dynamic setup? And finally, the bidding cost is related to the bid-ask spread. So if you're more explicit, then you can talk more about components of the bid-ask spread. So overall, great paper. Thanks.